Welcome back to Boni's Live, where we decode the crypto universe one chart at a time. I'm your host Boni, and if you're watching this on July 20th, 2025, then you've just witnessed one of the most extraordinary weeks in cryptocurrency history. Bitcoin didn't just break records this week, it absolutely obliterated them, reaching a mind-blowing $123,236 before settling into what I like to call the calm before the next storm. And trust me, after analyzing over 42 technical indicators, diving deep into institutional flows, and passing through enough economic data to make a Federal Reserve economist weep, I've got some fascinating insights to share with you today. Now, before we dive into the technical wizardry and fundamental analysis that'll make your trading game stronger than a double espresso on a Monday morning, let me remind you that this is not financial advice. I'm here to educate, entertain, and maybe help you avoid the kind of mistakes that make you question your life choices at 3 a.m. while staring at red candles. If you're new here, smash that subscribe button and ring the notification bell because we're about to embark on a journey through the most comprehensive crypto market analysis you'll find anywhere. And for my returning viewers, you beautiful chart-obsessed souls, you know we're about to get deep into the weeds of market mechanics. Today's episode is structured in 3 power-packed segments. First, we'll dissect last week's technical performance with the precision of a Swiss watchmaker. Then, we'll explore the fundamental forces shaping next week's trading landscape, including some absolutely crucial economic events that could send shockwaves through the entire crypto ecosystem. Finally, we'll craft specific trading strategies that could help you navigate the volatility ahead. So grab your favorite beverage, settle in, and let's decode what promises to be another pivotal week in the crypto markets. Let's start with the elephant in the room, or should I say, the digital gold that just made every traditional asset manager question their career choices. Bitcoin's performance this past week has been nothing short of spectacular, and the technical story it's telling is absolutely fascinating. As of this recording, Bitcoin is trading at $117,893, which represents a weekly gain of 0.38%. Now, I know what you're thinking. Boni, that doesn't sound like much. But here's where it gets interesting. This modest weekly gain masks an incredible intra-week journey that saw Bitcoin touch an all-time high of $123,236 before experiencing what technical analysts call a healthy pullback. Let me walk you through the technical landscape because the indicators are painting a picture that's more nuanced than a Picasso masterpiece. Starting with our oscillators, we're seeing a fascinating convergence of signals that suggest the market is in a state of dynamic equilibrium. The Relative Strength Index, our beloved RSI, is sitting at 65, firmly in neutral territory but leaning toward the upper end of the range. This tells us that while Bitcoin isn't technically overbought, it's certainly not oversold either. It's like that perfect spot on your couch where you're comfortable but not quite ready to fall asleep. The stochastic oscillator at 66 is echoing this sentiment, while the commodity channel index at 59 suggests we're in a consolidation phase rather than a breakout mode. But here's where it gets really interesting. The MACD is flashing a buy signal at 3,128, indicating that momentum is still favoring the bulls despite the recent pullback. Now let's talk about moving averages, because this is where the technical story becomes absolutely compelling. We're seeing what I call a moving average symphony, a beautiful harmony of bullish signals across multiple time frames. The exponential moving average at 10 periods shows Bitcoin at $117,197, providing immediate support. The 20-period EMA at $114,753 is acting like a loyal friend, always there when you need it. But the real story is in the longer-term averages. The 50-period EMA at $110,051, the 100-period at $104,978, and the 200-period at $104,978, $98,145 are all providing stair-step support levels that would make any technical analyst's heart sing. This moving average structure tells us that Bitcoin's uptrend remains intact despite the recent volatility. It's like having multiple safety nets when you're walking a tightrope. Even if you stumble, there's always something to catch you. But technical analysis isn't just about price action. Volume tells us the real story of market conviction. This past week, we've seen some absolutely fascinating volume patterns that provide crucial insights into market psychology. The surge to $123,236 was accompanied by significant volume, indicating genuine buying interest rather than a low liquidity spike. However, the subsequent pullback occurred on relatively lower volume, suggesting that sellers aren't particularly aggressive at these levels. This is what we call constructive consolidation. The market is taking a breather, not running for the exits. Looking at our key technical levels, the picture becomes even clearer. The 121,000 to 123,000 range has established itself as our new resistance zone. Think of it as the VIP section that Bitcoin briefly visited but needs a proper invitation to return to. On the downside, we have multiple support levels that create what I like to call a technical fortress. The immediate support sits around 117,000 to 118,000, followed by stronger support at 113,000 to 115,000. This latter level is particularly significant because it represents the former resistance that Bitcoin conquered on its way to new highs. The Fibonacci retracement levels from the recent swing low to the all-time high are providing additional technical guidance. The 23.6% retracement level aligns perfectly with our $118,000 support, while the 38.2% level coincides with the $115,000 zone. This mathematical harmony isn't coincidence. It's the market's way of finding natural equilibrium points. Now, let's zoom out and look at the broader cryptocurrency market, because Bitcoin doesn't exist in a vacuum. The total crypto market capitalization has achieved a historic milestone, crossing $4 trillion for the first time. This isn't just a number, it's a testament to the maturation of the entire digital asset ecosystem. What's particularly encouraging is the quality of this growth. Unlike previous bull runs driven primarily by retail speculation, this rally is being powered by institutional adoption. We've seen record Bitcoin ETF inflows of $1.18 billion in a single day, with institutional investors purchasing $15 billion worth of Bitcoin ETFs over the past 6 to 8 weeks. This institutional involvement is changing the very character of Bitcoin's price action. We're seeing reduced volatility compared to previous cycles, more sustained trends, and what appears to be a higher floor for price corrections. It's like Bitcoin is growing up, trading its teenage mood swings for adult-like stability. The correlation dynamics are also worth noting. Bitcoin's correlation with traditional risk assets has been decreasing, suggesting it's beginning to trade more independently. This is crucial for its narrative as a hedge against traditional financial system risks. So what does all this technical analysis tell us about the week ahead? Based on the current technical setup, I'm seeing 3 potential scenarios, each with different probability weightings that we'll explore in detail during our trading strategy segment. The base case scenario suggests continued consolidation within the $115,000 to $123,000 range, with a slight bias toward testing the upper end of this range. The bullish scenario could see a breakout above $123,000, targeting the $125,000 to $128,000 zone that several institutional analysts have identified. The bearish scenario would involve a test of the $113,000 to $115,000 support zone before potentially resuming the uptrend. But technical analysis is only half the story. To truly understand where Bitcoin is headed, we need to examine the fundamental forces at play. And trust me, the fundamental landscape for the coming week is absolutely loaded with market-moving events that could reshape the entire crypto narrative. Welcome to the Fundamental Analysis segment, where we dive into the economic and political forces that move markets faster than gossip in a small town. This coming week is absolutely packed with events that could send ripples or tsunamis through the crypto markets. Now, I know fundamental analysis can sometimes feel like watching paint dry, but stick with me because the events lined up for July 21st through 27th read like a thriller novel written by a central banker with a caffeine addiction. Let's start with the big kahuna, the Federal Reserve. While the Fed's next official meeting isn't until July 29th to 30th, this week is crucial because we're in what's called the blackout period. Fed officials can't make public statements about monetary policy, which means any hints or signals have already been dropped. And boy, have there been signals. Federal Reserve Governor Christopher Waller, who, by the way, is being considered for Fed chair if Trump decides to make changes, has been making some absolutely fascinating statements. Waller has been advocating for a 25 basis point rate cut at the upcoming July meeting, stating, and I quote, "The time has come to cut interest rates." Now, why should crypto investors care about Fed rate cuts? It's simple economics with complex implications. Lower interest rates reduce the opportunity cost of holding non-yielding assets like Bitcoin. When you can earn 5% risk-free in treasury bills, Bitcoin needs to work harder to justify its place in your portfolio. But when that risk-free rate drops to 4.75% or lower, suddenly Bitcoin's potential returns look more attractive. But here's where it gets really interesting. Waller's reasoning for rate cuts isn't just about economic growth. He specifically mentioned that tariffs are likely to have limited impact on inflation. This is crucial because it suggests the Fed is becoming more comfortable with the idea that some inflationary pressures are temporary rather than structural. Moving beyond the Fed, let's examine the global economic calendar, because in today's interconnected world, what happens in Beijing affects Bitcoin just as much as what happens in Washington. Monday kicks off with the People's Bank of China interest rate decision. The PBOC has been on an easing cycle, with the current rate at 3.00% after a reduction in October 2024. While most analysts expect no change, any surprise move could significantly impact global risk sentiment. Here's why this matters for crypto. China remains a massive player in Bitcoin mining and trading, despite regulatory restrictions. Chinese monetary policy affects global liquidity flows, and when the PBOC eases, it often leads to increased risk appetite worldwide. It's like adding more fuel to the global liquidity fire. Tuesday brings us the Reserve Bank of Australia meeting minutes. Now you might think, Boni, why should I care about Australia? Well, the RBA has been one of the more hawkish central banks, maintaining rates at 3.85% while others have been cutting. RBA Governor Michelle Bullock has been advocating for cautious easing, and any shift in this stance could signal broader changes in global monetary policy coordination. But the real fireworks start on Thursday with a parade of economic data that could reshape market expectations. We're getting preliminary PMI data from Germany, the Eurozone, the UK, and the US. Essentially, a global economic health check all in one day. For those unfamiliar, PMI stands for Purchasing Managers' Index, and it's one of the most reliable leading indicators of economic activity. A reading above 50 indicates expansion, below 50 indicates contraction. The German manufacturing PMI has been struggling, with recent readings of 49.0 suggesting the European economic engine is sputtering. This is particularly important for crypto because European weakness often leads to ECB dovishness, which increases global liquidity. The European Central Bank's interest rate decision, also on Thursday, could be the week's most significant event for risk assets. The ECB has been more aggressive than the Fed in raising rates, but recent economic data suggests they might be approaching the end of their tightening cycle. Any hints of future rate cuts could send the euro lower and risk assets, including Bitcoin, higher. Now let's talk about crypto-specific fundamental developments because this past week has been absolutely revolutionary for the regulatory landscape. The conclusion of Crypto Week in the US Congress has been nothing short of historic. 3 major pieces of legislation were debated: the Anti-CBDC Surveillance State Act, the Genius Act, and the Clarity Act. While none have been passed yet, the mere fact that they're being seriously considered represents a seismic shift in regulatory sentiment. The Genius Act, in particular, could be a game-changer. It would establish federal guardrails for US dollar-pegged stablecoins and create a pathway for private companies to issue digital dollars. This isn't just regulatory clarity, it's regulatory embrace. But perhaps the most significant fundamental development is the continued institutional adoption. The fact that Fannie Mae and Freddie Mac now accept Bitcoin as collateral for home loans isn't just a policy change, it's a fundamental shift in how traditional financial institutions view digital assets. The numbers speak for themselves. Bitcoin ETF inflows hit a record $1.18 billion in a single day this week. To put that in perspective, that's more than the entire market cap of many S&P 500 companies flowing into Bitcoin in just 24 hours. Let me share some insights from the smartest minds in the industry because their perspectives are shaping market sentiment in real time. Tom Lee from Fundstrat Global Advisors, who's been one of the most accurate Bitcoin analysts over the past few years, is predicting Bitcoin will hit $250,000 in 2025. His reasoning? Institutional adoption is accelerating faster than even the most optimistic projections. Vanek is even more bullish, projecting $180,000 for 2025 and an absolutely mind-blowing $2.9 million by 2050. Standard Chartered is calling for $200,000, while venture capitalist Tim Draper maintains his year-end target of $250,000. But here's what's really interesting. These aren't just random price targets thrown out for headlines. These predictions are based on sophisticated models that account for institutional adoption rates, regulatory clarity, and macroeconomic factors. However, it's not all sunshine and rainbows in cryptoland. Let me share some risk factors that could derail this bullish narrative, because a good analyst always considers both sides of the trade. The primary risk remains Federal Reserve policy. If inflation proves more persistent than expected, the Fed could maintain higher rates for longer, reducing the appeal of non-yielding assets like Bitcoin. Additionally, any escalation in trade tensions could hurt global risk sentiment. There's also the technical risk of profit-taking after such a strong rally. Bitcoin has gained over 26% year-to-date, and some investors might be tempted to lock in gains, especially as we approach the end of July. Geopolitical risks remain elevated, with ongoing tensions in various regions that could trigger flight-to-safety moves. While Bitcoin has increasingly been viewed as a hedge against traditional financial system risks, it's still correlated with risk assets during acute stress periods. But perhaps the most important fundamental factor is market psychology. The crypto market has matured significantly, but it's still driven by sentiment and narrative more than traditional assets. Current sentiment indicators suggest cautious optimism rather than euphoric greed. The Fear and Greed Index, while elevated, isn't in extreme greed territory. This suggests there's still room for upward movement before we hit dangerous levels of market exuberance. So, with all these fundamental forces at play, how should traders position themselves for the week ahead? What strategies make sense given the technical setup and fundamental backdrop? That's exactly what we're going to explore in our final segment, where I'll share specific trading strategies that could help you navigate the volatility ahead. Stay with me, because the next 10 minutes could be the most valuable part of your entire week. Welcome to the strategy segment, where we transform analysis into actionable trading plans. Now, before we dive into specific strategies, let me remind you that these are educational frameworks, not personalized investment advice. Your risk tolerance, time horizon, and portfolio size should all factor into your decision-making process. That said, based on our technical and fundamental analysis, I've identified 3 distinct trading strategies that align with different risk profiles and market scenarios. Think of these as your strategic toolkit for navigating the week ahead. Strategy number 1, the institutional accumulator. This strategy is designed for traders who want to build long-term positions while managing downside risk. It's based on the premise that institutional adoption will continue driving Bitcoin higher over the medium to long term. The setup is straightforward but requires patience. We're looking to accumulate Bitcoin on any dips toward the 115,000 to 117,000 support zone. This area represents the confluence of multiple technical factors: the 20-period EMA, the 38.2% Fibonacci retracement, and the former resistance turned support. Here's how to execute this strategy. Set limit orders at $117,000, $115,500, and $114,000. These levels provide multiple entry points if the market decides to test lower support. The beauty of this approach is that you're buying into strength rather than weakness, but at levels where technical support should provide a safety net. Risk management is crucial here. Set your stop loss at $112,000, which represents a break below the key support zone. This gives you roughly a 3 to 5% downside risk depending on your entry point, while the upside potential to the previous high at $123,000 offers a 5 to 7% gain. Position sizing should be conservative, no more than 2 to 3% of your total portfolio per entry point. This allows you to average down if the market moves against you while maintaining proper risk management. Strategy number 2, the momentum breakout play. This strategy is for more aggressive traders who want to capitalize on a potential breakout above the recent highs. It's higher risk but offers asymmetric reward potential if Bitcoin continues its institutional-driven rally. The trigger for this strategy is a decisive break above $123,500 with strong volume. This level represents not just the recent high, but also a psychological barrier that, once broken, could lead to rapid price discovery toward the 125,000 to 128,000 zone that institutional analysts have identified. Wait for a 4-hour candle close above $123,500 with volume at least 20% above the 20-period average. This confirms that the breakout has institutional backing rather than being a false breakout driven by retail FOMO. Entry should be on the retest of the $123,500 level, which often occurs within 24 to 48 hours of the initial breakout. This gives you a better risk-reward ratio than chasing the initial move. Set your stop loss at $121,000, which provides roughly a 2% downside buffer while keeping you above the previous resistance zone. Target the $127,000 level for a potential 3-to-1 risk-reward ratio. The key to this strategy is volume confirmation. Without institutional level volume, breakouts above major resistance often fail. Watch for sustained buying pressure rather than quick spikes that fade just as rapidly. Strategy number 3, the range trading specialist. This strategy assumes Bitcoin will continue consolidating within the established range while institutional buyers accumulate positions. It's perfect for traders who prefer multiple smaller wins over single large moves. The range is clearly defined, $115,000 to $123,000. That's an 8,000-point range, or roughly 7% from bottom to top. For range traders, this represents multiple opportunities to buy low and sell high within a defined risk framework. Buy signals occur when Bitcoin approaches the lower end of the range around $115,000 to $117,000, especially if accompanied by bullish divergence on momentum indicators. Sell signals trigger near the upper end around $121,000 to $123,000, particularly if momentum indicators show bearish divergence. Use RSI and stochastic oscillators to fine-tune entries and exits. Buy when RSI drops below 40 within the support zone. Sell when it rises above 70 near resistance. This helps you avoid buying at the top of the range or selling at the bottom. The beauty of range trading is that your risk is clearly defined. If Bitcoin breaks below $115,000 or above $123,000 with conviction, the range is broken and you exit all positions. This prevents you from fighting the trend if the market decides to break out of consolidation. Now let's talk about how to adjust these strategies based on the week's key events, because successful trading isn't just about technical levels, it's about understanding how fundamental catalysts can accelerate or reverse price movements. Monday's PBOC decision could provide the first directional clue. If China surprises with a rate cut, expect increased risk appetite and potential strength in Bitcoin. If they hold steady, the market will likely focus on Thursday's data deluge, and Thursday is the week's main event, with PMI data and the ECB decision. Weak European data could strengthen the case for global monetary easing, which would be bullish for Bitcoin. Strong data might delay ECB cuts, potentially creating short-term headwinds. Here's how to adjust your strategies based on these outcomes. Scenario 1. Weak global PMI data plus dovish ECB equals increased position sizes and lean more aggressive on breakout strategies. Scenario 2. Strong PMI data plus hawkish ECB equals reduced position sizes and focus on range trading with tighter stops. Scenario 3. Mixed data equals stick to base case strategies with standard position sizing. Let me share some advanced risk management techniques that can make the difference between profitable trading and painful losses. First, monitor Bitcoin's correlation with traditional risk assets. If correlation increases during stress periods, be prepared to reduce exposure quickly. Bitcoin's safe haven narrative is still developing, and during acute market stress, it can still trade like a risk asset. Second, use dynamic position sizing based on volatility. When Bitcoin's 20-day volatility is above 60%, reduce position sizes by 25 to 30%. When volatility drops below 40%, you can increase exposure slightly. Third, never risk more than 10% of your total portfolio on crypto positions, regardless of how confident you feel. The crypto market can move against you faster than you can react, and preservation of capital is always the top priority. For the week ahead, my base case expectation is continued consolidation within the $115,000 to $123,000 range, with a slight bias toward testing the upper end. The institutional bid appears strong enough to prevent significant downside, while profit-taking near recent highs could cap upside momentum. The most probable scenario sees Bitcoin ending the week between $118,000 and $122,000, setting up for a potential breakout attempt in early August. This would align with typical summer trading patterns and give institutional buyers more time to accumulate positions. Remember, successful trading isn't about being right on every trade. It's about managing risk, staying disciplined, and positioning yourself to benefit from high-probability setups. The strategies I've outlined today provide frameworks for different market scenarios, but your execution and risk management will determine your success. As we wrap up today's analysis, I want to emphasize that we're witnessing a historic transformation in the cryptocurrency market. The institutional adoption we're seeing isn't just a temporary trend, it's a fundamental shift that's likely to support higher prices over the long term. But remember, even in a bull market, volatility is your constant companion. Stay disciplined, manage your risk, and never invest more than you can afford to lose. The crypto market rewards patience and punishes greed, so keep your emotions in check and stick to your trading plan. And that's a wrap on another deep dive into the crypto markets. We've covered a lot of ground today. From technical analysis showing Bitcoin's continued strength despite recent consolidation, to fundamental factors that could drive the next leg higher, to specific trading strategies for navigating the week ahead. The key takeaways: Bitcoin's technical structure remains bullish with strong support levels. Institutional adoption is accelerating at an unprecedented pace, and this week's economic events could provide the catalyst for the next major move. If you found this analysis valuable, please hit that like button, subscribe if you haven't already, and ring the notification bell so you never miss our market updates. Your engagement helps us reach more traders and investors who can benefit from this type of in-depth analysis. Drop a comment below with your thoughts on Bitcoin's next move. Are you bullish, bearish, or neutral for the week ahead? I read every comment and often feature the best insights in future episodes. Follow me on Twitter @BONI232849 and on Discord @BONI_23043 for real-time market updates and quick analysis throughout the week. I'll be monitoring all the events we discussed today and sharing my thoughts as they unfold. Remember, this content is for educational purposes only and should not be considered personalized investment advice. Always do your own research and never invest more than you can afford to lose. Until next time, keep your charts close, your risk management closer, and remember, in the world of crypto, fortune favors the prepared mind. This is Boni signing off from Boni's Life. Trade safe, trade smart, and I'll see you in the next episode.